Alright, welcome everyone to my class, which is the chapter 3 for the financial analysis for the corporate finance class. This is using the Foundation of Financial Management 18 editions by McGraw-Hill, Block, Hurt, and Danielsons. Okay, we have a number of learning objectives here. The first one is to recognize the rationales that provide a meaningful comparison to each industry, explain what the ratios are, that what they measure of, and we call the U-DuPont system analysis, which identifies the true sources of return on asset as well as return to shareholders, and detail the trend analysis and how it shows. Explain why the reporting must be further evaluated. Okay. In the video before, in the previous class, I have mentioned to you that there is a number of issues of ratio analysis. Not only enough to analyze, but you also have to look into detail. We have I'll give you an example of Enron case before that the company went belly up because of the financial reporting, and even though the ratio looks good, but they are actually not really good. Okay, let's look at the financial ratio now. Financial ratio used to weight and evaluate operating performance of the firm, measure the firm, measure relation with other values, compare performance records against similar firm in the industry, and then evaluate the company management, and then financial data reported by S&P and Poor 500. This is the standard of comparison. What are the classification system? The profitability ratios, that's the standard way. It includes profit margin analysis, return on assets, on investment of the ratio, return on equity. That's for the profitability ratio. For the asset utilization ratio, it will be a receivable turnover, average collection period, inventory turnover, fixed asset turnover, total asset turnover. And then also third one, liquidity ratio, include current ratio and quick ratio, while debt utilization ratio include the debt to total asset times interest earned and fixed charge coverage. Okay, we're gonna move into profitability ratio. First process, measure firm ability to earn adequate return in terms of sales, in terms of total asset, is in terms of invested capital. And then asset utilization ratio, which is category B, measure the speed at which firm turnover in terms of account receivable, inventory, long-term assets. And then equity ratios, which emphasize the ability of a firm to pay off certain obligation as they become due. And then debt utilization ratio, as you for that position of the firm, evaluate in light of asset base as earning power. So remember, all these ratios are being used when I was an investment analyst with Nomura Securities as well as with Morgan Grenfell. When I was with the investment firm, securities firms, I do all this ratio almost daily on all the publicly listed company as well as the company that are ready to go public, IPO. IPO stands for initial public offering. Classification system, okay. User financial have different degrees of importance of category. For potential investor and security analysts, this is what I do most of the time. Primary consideration will be profitability. And then secondary is concerned liquidity and debt utilization. So every time there's a company wants to go public, raise funds, what I'm looking for is the profitability ratio. Is this company profitable or not? How are they compared to its peers? If they come good, better, or the average? That's the thing. And then I also need to know how is their debt utilization. Are they highly geared, highly leveraged with too many debt, or they are low debt? Okay. For the bankers, the first consideration will be liquidity ratio. It means the ability to pay back their loans. For the long-term creditor will be bondholders. Consideration will be debt utilization ratio, which is debt to total asset as well as profitability ratio. This is typical, guys, in a financial statement of ratio analysis. What you will see here, you got a income statement and you have the balance sheet. Once you have this, you're gonna do an analysis of our ratios. There you go. First thing, profitability ratio. Number one, profit margin, net income divided by sales, which is 5%, industrial is 5.7. So it's the company is below the industry average. Return on assets, which is net income divided total asset, which is 12.5, which is higher, but the average industry is 10%. Okay, our net income divided sales or times sales divided by total sales, total assets. So you get 12.5. So it's the same thing, 10% here. Number 3, return on equity, which is net income by stockholders' equity. This one is 20%, is higher than the industry average 15%. Or number B, return on asset investment, in bracket 1 minus debt divided by assets. So it's 20%, 15%. Which way you reporting is the same. The most important thing is you are able to know and compare it with the industry average. Okay. After the satisfactory return on asset can be derived through high profit margin, rapid asset turnover, and combination of return on asset, which is profit margin times asset turnover. Okay. That's we're gonna satisfactory return on equity can be derived through what? High return on total asset, generous utilization of debt, as well as combination of both. Look at this return on equity. Return on equity is return on asset, which is investment, divided minus debt asset, which is equity. Okay. So how are you gonna do it in the DuPont analysis? The DuPont analysis here is showing at return on equity. Net income divided by sales divided by total asset. You got here net income by time by sales. You got the profit margin. Sales divided by total asset. You got the asset turnover. Okay, you got the return on asset. Total debt with total asset. You got the debt equity ratio. When you multiply this return on asset minus debt asset, you got the return equity. So that's a DuPont analysis. That okay. Then we're gonna use utilization ratio. What the utilization ratio to look at your receivable. Receivable turnover will be sales credit with a receivable which is 4 million by 350, which is 11.4 compared to 10 times average. So the turnover is higher. And number 5, the average collection period account receivable is 350 divided by average daily sales rate, which is credit sales divided within the sales of the 2 period, which is 32. You got 36 days. So collections is lower. That's the average is 36 days. That's good. That means this is good news. Inventory turnover, sales divided inventory. You got 4 million sales. Inventory is 370, which is 10.8, which is means it's good compared to 7 times. Okay. Let's look at the next one. Relate to balance sheet again. Receivable asset relate to balance sheet to income statement. Okay. Receivable turnover again. Here, Sexton Company is 1.4. Okay. 10 times at 10.8. This is the same thing basically. Okay. Make sure the ratio compute by using cost of goods sold as the numerator. Okay. That can be calculated. All right. Let's look at the next one, which is the 15. Profit margin. This is a comparison between Walmart and Target. So you're going to compare between Apple versus Apple. You cannot compare Walmart with Daihatsu or Walmart with Yamaha. That's not the same comparison. So you need to compare orange with orange, apple with orange, apple with apple. Okay, that's the idea. You cannot apple versus orange. So Walmart and Target are in the same industry, which is in retail industry. So you're gonna look at this profit margin itself, comparison between the two of them. Look like Target has a higher profit margin, lower asset turnover, lower return on asset. That equity is higher. Okay, that equity is higher, and the return on equity is 22.43, which is the higher one. So which one it is depends on what you like to invest. You look at all these components. Okay. Now a fixed asset turnover is sales divided by fixed asset, which is 4 million divided by 8 million, which is 5. Industry average will be 5.4. Total asset turnover, which is sales divided by total asset, which is 4 divided by 1.6 million. You got 2.5, which is higher, and 1.5 times. Okay, each ratio has its own use of calculations, and it helps you decide whether the utilization is good or better in terms of the efficiency side. And then current ratio here, the higher it is, the better, because current ratio, current asset, current liability look like Saxon have higher average 2.67 compared to industry average 2.1, while quick ratio is current asset minus inventory, where the current liabilities we get is 1.43, which is 1.1. So the company here, in terms of liquidity ratio, is much better than the industry. So this is quite liquid as compared to industry. Okay, let's look at the registration depends if the firm can meet maturity, it can do. So the higher it is, the more likely they are able to pay out. Excuse me. And look at the major prudence of the debt management policy of the firm. The total debt, which is divided by total asset, which is 37.5, then divided is 33%. So the average, which is this, means that the higher debt. Okay, income before interest tax, which is 550, divided by interest, which is 50,000, is 1.11 times, which is 7 times. Okay, which is they can cover the interest. So the higher it is, total debt, they have the higher debt. Okay, that's higher debt means they are less they have less efficient in terms of debt ratio. Okay, income before tax, which is 550 by 511 times, which is higher than the industry average. And then fixed income before fixed charges and taxes, we have fixed charges, which is 6 times, which is 5.5. It measures the prudence of debt management policy of the firms. Okay, so fixed charges coverage measure the firm ability to meet all obligations rather than interest payment alone. So for example, you have an income before income tax, which is 550 here, minus the lease plus the lease payment here, 50,000, not minus. Okay, lease payment here, 50,000. So income before fixed charges and taxes will be 600,000 here. Okay, so in terms of ratio analysis, as based on this one, we're going to compare here. What is it? Does it mean? In the conclusion, we're going to go into the detail. Profitability here below average. This is above average due to high turnover. This is good to ratios 2 and 11. Asset utilization, they look good here. Below average is here because it's 5 compared to 5.4. Still has asset turnover looks good. Liquidity is the good one as well. And D is slightly more debt on the debt to utilization ratio. So the best one actually of all these 4th category is the liquidity one, is much better. But the only one here in the asset utilization, there's one component is below average here. Okay, the same thing here, below average is 1 on the profit margins below, but these two are good. Okay, slightly more debt here, this is too good. So I guess the perfect condition at the moment is the liquidity ratio. Over the course of business cycles, sales and profit expand and contract. Ratio analysis for any year product does not reflect year picture of the firm. The analysis reflects performance over a number of years without industry conversion, may not reflect the complete pictures. Give pictures of the performance over numbers of years against the industry average. That's correct, right, guys? You always compare. When I was an investment analyst, we always compare at least 2 years. That's the minimum, at least 2 years. But the average we do is at least 5 years. 5 years financial forecast. We always compare. We want to make sure there's consistent performance there. If there is not, then we have to dig down deeper. Okay. So this is a typical profit margin compared to the industry. Sector is below one. The asset turnover is better here. So in each graph, it gives you the tell story which one is better or not. Okay. Return on asset, AMD here, really low. B1 is better. Here is almost the same. Okay, and then here is below for return on equity. So that's this is trend analysis. So basically, you take over a trend of from this one look like 10 years. The average when I was in the investment analyst in Nomura and Morgan Grenfell, we use the 5 years comparison. When we do financial forecast, we also do the same thing. We use 5 years. The major problem of inflation is that revenue is stated in dollars. Plant and equipment may have been purchased at lower price level because of the inflationary cost. I think after the COVID-19, for the last 4 years, 2 years ago, all the prices going up because of the inflationary pressure in the economy. Okay, profit may be more functional of increasing prices, the satisfied performance. We have seen a number of countries that has problem with inflation. The best example is number 1 is Zimbabwe, number 2 is the Argentine. Those two economies are in trouble because the inflation rate is so high. The money become worthless every time the price going up and up and up, and the people is into desperation, getting into desperation as well as misery. Okay, let's look at again in terms of the financial report. Distorted because inflation that is affecting financials. That's correct, guys. So look at again the next one, stain one, net income statement. This is another statement here, sales, and then we have after tax income, which is 53. Yeah, 10% of sales tax, and then we're gonna look at the next one, which is 26 here, after tax income in 2021. Okay. And then we're going to look at the next comparison, Technic Chemical Company versus A-Drive Company. The replacement cost versus historical cost. We have an increase of replacement cost 28.4%. Here it does 15.4%. You compare each of the industry. One is chemical company and drug company. So you can see the difference here. Replacement cost data, study of chemical, drug and industry between 76 to 78. 76, 77, 70. So 3 years, okay? So you will see the average of the return on asset here. Good example here is very low. Replacement cost is historical as is very 6.2 compared to the companies. The other company is much better in terms of the return in asset as well as in terms in equity. Okay. Look at the next illustrations. Will be replacement cost, reduce income but increase asset. It is increase in asset, lower debt to asset ratio. It decrease the debt to asset ratio because of the financial leverage of the firms. And then declining income result in the decreased ability to as well to cover interest costs. Alright guys, this inflation, it is a situation declining of inflationary pressure. This is deflation. It means that instead of the price going up, price is going down. Okay, that is why is that? Because there's a lack of purchasing power, maybe. Because of purchasing power, people cannot buy anymore. Nobody buy, then the price is going to go down. Okay, this is we've seen many times in the price of property, home property, whereas there's inflation and people cannot afford no more. There's the price slowly coming down. Okay, financial assets such as stock and bond have potential to do well. In terms of disinflation, tangible assets like personnel will fall. Okay, deflation is actually a declining process affecting everything from bankruptcy and declining profit. That's correct, guys. When you have a deflation, that the price is going to go down. Okay, and the cost going to be remain the same. Instead of profit going to be higher, it's going to be smaller, lower. Okay, that's the idea. What is the elements of this report income, which is affect the change of prices, reporting of revenue, statement of non-recurring items, tax write-off policies. Okay, so income statement will be conservative A, report highly conservative B. So you took a good example with the two comparison. One is 350, the other is 700, high income. So we are seeing, make sure, guys. The key important thing is that in every financial statement, it has to be good in terms, not only good, but also can be drilled down. You have to drill down the analysis, make sure there's no funny window dressing, there's no fake numbers. We have seen in the past, Enron is a good example of a company that when bankrupt and directors and the owners get jailed because of that reasons. Okay, they are reporting high income, but they are actually losing money. Okay, recognizing revenue as well as profit before its time. I have done IFRS 17 project for the insurance company. For that project is basically recognizing revenue and expenses at the correct time. So that kind of reporting is that we have to make sure everybody is follow the same standard. I think the only country now in the one that do not use IFRS 17 or adopt the IFRS are American company, US based. Okay, they still follow the GAAP style. Okay, the explanation of discrepancy. If there is any discrepancy, you need to discuss further. You consulting firm may defer revenue recognition of the sale until each payment is received. That's the key part for a conservative company. Other firms may attempt to in fully effect the sales as early as possible. So this is what happens in Enron. They recognize sales that is as early as possible, which is not supposed to be. Conservative also that does until the payment receives. So there's two extreme. One to the left side is not too conservative, the other is too aggressive. So at the end of the day, you need to follow the IFRS, International Financial Reporting Standard. Recognize the revenue and expense as is happening. Okay. Cost of goods sold can use different accounting principle. Company use LIFO versus company use FIFO. So in North America now, in the old days, LIFO is acknowledged, but now in North America, all LIFO is no longer allowed. Okay, so only FIFO, moving average, and specific average, specific calculation. So guys, LIFO is no longer allowed here. Okay, and then financial treatment of R&D costs. R&D cost means research and development. Some companies capitalize the R&D into the value of the fixed asset. So that is basically the next one, which is extraordinary gain and losses, including extraordinary events or computing current income, and leaving them out. On the net income, use different methods such as financial reporting, use inclusion or exclusion in extraordinary gain and losses. Each item must be examined financial statement rather than accepted at bottom line figure. Okay, the key part, if there's a substantial jump of the earnings, you need to drill down into detail, very much into detail, to check what it is coming from. Okay, so some some, because it is most company, they like to have a short-term goal to provide big bonuses to the board of directors, to the executive. So they have tendency to have extraordinary gains or losses. A good example are property sales, and then other sales that is pushing the earnings up. But those are non-operating income. Okay, those are non-operating earnings. So you have to examine. If let's say you are in the non-property business, but you have a substantial jump on your earnings based on the property sales, that is not a real sustainable, profitably growth. Okay, so you have to examine very carefully. So guys, so financial ratio, basically, to sum it up, you have to examine that ratio and compare it to the industry standard, and if there's any substantial jump within historical side, you need to do a drill down. The key point is doing a drill down and to check whether they are good or not in terms of the numbers. That's the key part. Okay guys, so thank you for this class. I'm gonna meet again with you in the next chapter. Bye bye.